before handing over to Mike Burkart, the editor of the Finance series, to introduce the Finance Prize, let me just say something about the prizes more generally. So ECGI has the tagline, Leading Research with Global Impact. And the research, one of the main vehicles for the research to come out is the working paper series. It's open access, it's free of charge, it's available through the ECGI.global website. We pay SSN, now Elsevier, quite a lot of money to distribute the working paper for us. So it really is global and it is core of what ECGI does. The series does have quite a lot of visibility, so it's good also for authors to put papers in there. And last year, the remarkable fact is that we had a record number of working papers. We had 140 working papers. So people have been really productive during the COVID period. They have been writing a lot of papers, and many of them are extremely good. So to honor the people who put papers in and to highlight the research, every year we give out for these two working paper series a best working paper prize. And there's one for finance and one for law. The Finance Prize this year is sponsored by the European Corporate Research Foundation, which has as its main donors Investor AB, AstraZeneca and BlackRock. And as I said, Ido van Thadden is going to award the prize. And then the Law Prize is sponsored by Cleary Gottlieb, and it's going to be given out by Amir Licht and Roberta Bonsignora. And with this, I'll hand over to Mike Burkart to explain to you how his committee chose the prize, who the prize winners are, and everything else there is to know about the Finance Prize. Mike, I hope you're here.
Yes, Marco, I am. Thank you, Marco. Okay, as Marco indicated, there were two prizes, so we had quite a few entry in the finance working paper series, so 70 papers roughly. So on a random draw, the chance of winning is roughly 1.5%. So there was quite a bit of competition. And the prize was chosen by me and the editorial board of the finance working paper series, which are Franklin Allen, Julian Franks, Marco Bogano, Javi Vives, and Luigi Zingaris. And as for the criteria, we were looking obviously for high quality paper on the academic dimension, but also having impact or potential for impact. Obviously, it's early days since these are working papers, and relevance. And while the winning finance paper has been announced previously, let me just remind you for those who have forgotten or have not heard who is winning. The winning paper was by José Luis Peydro, Andrea, Polo, and Enrico Sette, and the title was Risk Mitigating versus Risk Shifting, Evidence from Bank Security Trading in Crisis. So the paper really is empirically looking at the classical theme or idea in corporate finance, namely whether or not firms close to financial distress or in a difficult financial position engage in risk shifting. That means make decisions but increase the value to the shareholders but impose costs to other stakeholders. And so the most prominently that would be the creditors. And the alternative or competing hypothesis would be that firms which are close to financial distress or in difficulties would be more cautious with the purpose of trying to stay alive as opposed to increase the risk of going bankrupt. Now, obviously, this is a classical theme in corporate finance, and hence not the first paper who is looking at this question, but it does add quite a bit in our view, the paper by José Luis and Andrea and Enrico. And what they do in particular here is they're looking at whether more fragile banks, meaning with less sort of capitalized banks in Italy, how do they react in the securities trading as shocks come by? And the exogenous shocks are the financial crisis, the euro market crisis, euro area's debt crisis, and the COVID crisis. And so the issue is, here comes the shock. Do more fragile banks, do they shift their security holdings or their trading activities such that their portfolio becomes more or less risky? Okay, and now obviously, so this risk shifting, as I mentioned before, has been studied also for non-financial firms, for banks by other people, and also for other firms in the financial sector. Now, banking or the financial sector, and in particular security trading, is in my view a very suitable setting to actually study the risk shifting hypothesis for a couple of reasons. First, it's actually relatively easy for a banker to quickly change the risk exposure by buying and selling other securities. If you compare with an industrial firm, it's not so easy to change from car production to I don't know what. Just sort of very quickly respond or change the risk exposure in your operational activities is much easier for financial firms. So that's number one. And number two, very closely connected, the stuff is also extremely easily scalable. Just double up the money and you sort of double up the risk exposure. Second, and this is now more closely to their paper as opposed to a general remark, is actually the percentage of assets which are held by the Italian banks in securities is a substantial fraction of the assets. So if you change the riskiness of the securities held in the portfolio of the banks, you do actually substantially affect the whole risk exposure of the bank. And last but not least, I think, and here is presumably a paper adds the most, is sort of, it's not so easy in many settings to figure out how risky is actually an operation of a firm. But here, with banks, and in particular with the portfolio of securities they hold, you can actually get very reasonably precise information about the riskiness of the individual assets, and then actually really measure and track how much the risk exposure has been changing. Okay, and now so this is why I think the paper is really outstanding, because it can test the risk shifting hypothesis really much more cleanly than many previous papers have done. And now the authors will be coming and give a short, I don't know which of the three will do it, but give some details, but just give me the punchline. So what they find, and that this is opposite what previous papers found, but namely more fragile banks did not increase the risk exposure when hit by the shock, but they actually decreased the risk exposure. So they are not trying to benefit shareholders and at the expense of others, but try to basically keep the franchise value alive. And when the paper goes on, and as is standard or required nowadays, a battery of robustness tests whether or not this is really true, with different measures of what is a financial crisis, etc., etc. And it all seems to be very robust, their main finding. And perhaps last but not least, sort of what is driving their findings. So you could think, on the one hand, it's the banks' own incentives to maintain or preserve their franchise value, or it could be just regulation. And they run sort of several tests, and their findings suggest that it is actually the bank's incentives rather than regulation which drives their finding. So let me just to conclude that Jose Luis, Andrea, and Enrico study a classically and highly relevant question, and I do an extremely careful analysis, and they shed new light on the issue. And I'm fairly confident that there will be further papers and people looking into this question, inspired by that. So it's for me to hand over to Elu, correct, Marco? Huh?
That is correct.
That may be the case, Marco. Should I take over?
Yeah, absolutely. And then we want to hear from the prize winners to say something about their paper.
That is, in fact, much more important. And
well, I wouldn't say normally you would be giving out a check now, Elu, but
yes, in fact,
you can give out some Bitcoin.
A bit. I'm not used to handing out electronic copies of digital rewards. In fact, I'm not even sure what I should do. I could just say a few words and tell Andrea, Enrico, and Jose Luis that something will come by email at one stage, but even that I don't know. And so in that sense, let me simply say, in the real world, we would now be standing in front of a clapping audience, and I would hold a document in my hands, which I would now hand over to you, and we would all nod and look very seriously. And Andrea, Enrico, and José Luis would be very happy, and I would be proud. And then I would now hand over this document, which I guess Elaine will send you in some digital version later. And I can only, the only thing I can do here is I can certify that Elaine will do that, because Elaine is a very reliable person. And so in that sense, we have this intermediary here, which is certifying to the fact that you will get this document. I'm very happy that this paper has been chosen. I had looked at it before. It's great work, and thanks a lot for being available. I saw all three of you are, in fact, not only here, but even with their video camera on, which is a privilege in these days. And so I'm very much looking forward to hearing from you what you have to say. I should just say a brief word about the European Corporate Governance Research Foundation. As Marco said before, the foundation has been founded, in fact, in 2013 to support the ECGI on a hopefully larger scale than what ECGI is able to do on its own, and has been doing very skillfully on its own until then, and continues to be doing, namely funding itself. And in fact, just like much of ECGI, also the foundation of the ECGRF is mostly due to Marco, and in fact also to a significant extent to Leo Goldschmidt, who's also here. And what it does is in fact support a significant amount of the activities in Brussels and around the globe, and now on the internet, and has been able to expand ECGI's activities quite dramatically. And I think we have all witnessed that during the last 10 years. One of the things that ECGRF is typically not doing is directly sponsoring research, but since our previous sponsor of this prize has quite abruptly stepped down for reasons I don't want to discuss, we did have the problem of handing out this prize without any prize money, and then have a law prize with a lot of money coming along, or stepping in a kind of emergency action, and also adding a price tag to this finance prize. And the board of the Research Foundation has been, in fact, quite happy to do this. And I think it's also a good sign, because this prize, like the law prize to be handed out by Amir later, is of course one of the showcases of what we're doing at ECGI, and is something to be seen and something to be appreciated. And so the foundation is very happy to support this. And in the name of the board of trustees of the foundation, I'm therefore congratulating you for this prize, and for the great research that has gone into that. With these words, let me literally step out of the video and hand over to you. Who is going to talk? Andrea, Enrique, or José Luis? Or do you have some concert which you have to?
I will introduce the paper.
Good, thank you. Thank you, Andrea.
Thank you very much. We are deeply honored to receive the prize, truly. So thanks to the ECGI Foundation, to Mike, Burkart, and the whole jury, and to everyone, Thadden. So we were super happy, but so this is truly an honor. So I need to thank Mike. So Mike did a nice introduction, but did the introduction, did the motivation, the summary, and the identification strategy. So much better than what I was gonna do. So in a sense, I think I will be faster on that. So I'm here with also José Luis from Imperial College, and Enrico Sette from the Bank of Italy are also here. So the question, as Mike said, is when a bank becomes close to distress, does it start to gamble? Okay. Or instead it becomes more cautious. And so we look at this by looking at security trading during financial crisis. So risk shifting, of course, is key, for us, it's a key results in corporate finance due to limited liability. If shareholders are close to distress, incentives payoff is convex, so shareholder incentive to increase risk at the expense of other people, other stakeholders, so Jensen and Meck in 1976. Now, if this is the case, this should be particularly true for banks. Super leveraged corporation, low skin in the game, opaque industry, some of the liabilities are government or explicitly or explicitly guaranteed. So perfect place to look for risk shifting. Now, however, there are some other forces. There are regulation, supervision, or bank-owned incentives, so that you want to be alive, as Mike was saying, because you have some franchise value that, as a going concern, you want to keep. So push shareholders of bank to reduce distressed banks, to reduce risk instead. So theoretical literature, in fact, actually, if one looks carefully, offers an ambiguous prediction of what we should expect. Now, why do we want to look at this particular aspect? Look, security trading crisis, as Mike was saying very well. So you want to take risk, very easy to do it with securities. You call the head of the bank wants to take risk, call the head of the trading floor and just say scale up on security with a lot of risk. Right? You can do it very fast. So in a sense, this is a manifestation of the so-called paradox of liquidity of Myers and Raja 1998. In a sense, investors want corporations where they invest in to be liquid, but the more liquid they are, they cannot really commit to an investment strategy that protect the investors. Because if you want to do risk shifting, asset substitution, you need to have liquid assets to do that. So securities are large, 20%. This is not just Italy. This is Europe. This is US. So this is common. Securities are a large part of the bank assets. We have on the, so it's difficult if you want to know the riskiness of the assets. So here we have really supervisory data on each security, each month of each bank. Then the big thing is that when you look at for risk shifting, in particular in banks, which are heavily regulated, it would be, well, is it they do it because the regulators ask them to do, or because they want to do it? So what is driving really? So in this particular frame, in this particular situation, we can really control for regulation, because what we can do is that we can look at the securities traded by banks, which have the same risk weight. Okay, so for the regulator, they are the same, but one is higher yield, one is a lower yield, and we see where banks go. Then we will also do additional tests to say, okay, let's say there's no regulation. Is it supervision? Maybe supervision is the supervisor come in, enter into the bank and say, well, you should do this and that. Or maybe it's more that the banks themselves really want to become more cautious, maybe because they want to preserve franchise value. And why we look at franchise crisis? Well, of course, if there is a shock, the incentives to risk shift are certainly high. Now, this is I think this is a nice connection with the great lecture that we heard. Just after the crisis, regulators and academics were concerned and started to describe what happened and started to describe things in terms of, well, there is some casino banking and some good banking. The casino banking is where these bankers do with the securities, they gamble, while there is, good banking, which is lending. And in terms of the iron law that Professor Romano described to us, well, regulators wanted to act immediately. In the US, there was the Volcker rule, part of the Dodd-Frank, specifically prohibiting these proprietary trading. Now, there's been a lot of relaxation of these exclusion to the ban, and then further softening during the years, but it was the spirit. In the UK, there was a Vickers report, in the UK, the Riccani report, which immediately they said, well, we need to, okay, maybe not prohibit, but at least segregate, market-based casino banking on one side, good banking from the other side, okay? European banking regulators have been thinking of going a step further and say, look, these banks were buying all these sovereign bonds, which were so risky. You know, we need to limit this. Somehow we need to introduce some limit to how much government bonds banks can hold. Now, to be fair, here, in a sense, we don't need sunset provisions because in Europe, none of these proposals have actually today been implemented. Now, what is the previous empirical evidence? As Marco was saying, that this is an old question, right? I mean, we teach our students risk shifting, so it's an old question. And the evidence so far was largely in favor of this. Okay, this was mostly coming before the financial crisis. There is this paper by David Landier, so Landier, Azrael, and Tesmar was looking at one, you know, an evidence from one bank going bust during the subprime crisis, and they were suggesting, you know, risk shifting disease. You know, we teach this to students because, you know, and in fact this happens in reality. Now, not only that there was, you know, there is evidence in general, and of course, on this very important topic for banks, but there are specific literature on securities trading in crisis. So there are, after the European sovereign debt crisis, Sharon Stephan Review of Finance, John JFE, Drescher-Return, JF, so Journal of Finance, Altair Pagano-Simonelli, Review of Finance, using Euro area data, they show basically that distressed banks, so banks in distressed countries, in particular the fragile ones, they bought a lot of sovereign bond. Conclusion, risk shifting in securities by more fragile banks during the crisis, right? Sovereign bonds during the sovereign debt crisis were risky, so fragile banks buy them. So this is a further manifestation of what we already knew. Now, what is a bit of concern with this previous literature, that this previous literature does not consider all securities, okay? Only consider government bonds or securities that banks can pledge as a collateral to borrow ECB liquidity, which tend to be typically government bonds. Most important, even more importantly, the unit of observation is never the security. So these papers were not able to distinguish between security with the high and low yields. So for instance, aggregate data that typically this paper tend to use may show that two banks have similar large amount of government bonds. But if you do not have granular data, you cannot distinguish whether you are holding a 10-year government bonds with high yield or a 1-month government bond. 1-month government bond that's much lower yield. Okay. So in this paper, to address these data limitation, we have a proprietary data set from the Bank of Italy, where we have security level data of all security investments by all Italian banks at a monthly frequency. And not only we know the security, but also in which portfolios the securities are. You know, there are held to maturity, available for sale, trading book. We'll see these come up to be pretty important for identification. Now, we exploit the global financial crisis, the Euro debt crisis, and then at the end, we also look at COVID-19. We consider only bonds, which are like 81% of these securities that banks hold, because for these securities, we can obtain yields, prices, issuer ratings, so have all the information about these securities, but we also do tests where we use all the securities. So what is the main identification strategy? Is that we want to see, so the net buy, so the trading of each security by a particular bank of a certain security in a particular month, and we're interested in this tripole interaction. So after a shock, do banks with low capital go for higher yield or for lower yield? Okay. So a measure of trading is just the Davis-Altivanger measure of change of growth, you know, of a particular security by a particular bank, particular time. As a security heterogeneity, we look at yield. As a shock, we look at the Euribor oil spread. I will say something a bit more on this. As bank balance sheet variable, we use at the capital in excess of regulatory minimum, but we could look here, we've looked at many very different definitions of capitals that are similar. And we also look at another source of bank balance sheet fragility, because capital is one, but typically another one is exposure to the wholesale funding market. Think of Northern Rock going bankrupt because of dry up, the funding market, short-term funding. So we look also at that other measure of fragility of the bank. In particular, we can, since we have very granular data, I said we can put very large amount of fixed effect. In particular, you see here rating maturity time. So what is rating maturity time? These are the determinants of risk weights. Okay, so in a sense, it's like saying, okay, within the same regulatory risk weight, what do banks do? Go for high yield, go for low yield. Okay, we can also put security times as a fixed effect, which means that it's the same security, and in particular month, we see whether fragile banks buy and fragile or versus the strong banks selling. So what is a crisis? A crisis is we need to have a measure of crisis. So the first index that we look at is an index which is typically used for this type of to measure financial distress, or Euribor or EIEF spread, that is the interest rate that bank lend at the interest rate at which bank lend to each other. And of course, you see summer of 2007 it showed up when this crisis entered into Europe. There was famous. There was the BNP Paribas was reneged redemption on funds, and then the subprime crisis entered Europe on that day. Then we have Lehman. Then we have the sovereign crisis, or the typical picture of these periods. So there is all these three peaks crises, the two of the subprime, the starts, Lehman, and the sovereign. So in contrast to the risk shifting hypothesis, in contrast to the empirical evidence, we find strong evidence that in response to a stress, less ex-ante capitalized banks go for lower yield. Okay, as you can see, we can put large batteries of controls and fixed effect. For instance, here, as we said, we do within regulatory risk weights. Now, these are robust, since we can try to shake these as much as is possible and see whether it stays there. So alternative definition of dependent variable, alternative definitions of bank variables, alternative definition of risk. We use yield instead of rating. Control for all macro variable possible. For instance, here an important one, of course, is the ECB monetary policy. We exclude too big to fail banks, which can be different. Now, in finance, we know that higher yield may not mean higher risk, right? It depends on the correlation with existing portfolio. So we control for the correlation with the entire portfolios, and we find the same results. So this is why we talk about risk taking. We use several different indexes of market stress, or we just use dummy for Lehman, dummy for sovereign crisis. Now, as I mentioned, another possible source of fragility is exposure to the wholesale finance, exposure to the interbank market in the liabilities. So when we add these, you see results remain the same, and you see the triple reaction is not significant. But it's an interesting one is the double interaction. So in general, it's true that banks with which take more risk on the liability sides, because they're more exposed to the wholesale finance, they take, in general, not after a shock, in general, they take less risk on the asset side, which suggests risk management, more type of evidence rather than gambling or more risk shifting type of. Now, as I said, why? Regulation, supervision, economic forces. Now, regulation I kind of already mentioned. So what is the concern? Now, of course, you are low capital, you go for securities which have low risk weights simply because you cannot afford other type of securities because you do not have enough capital. Now, so I already showed you these results with these regulatory risk within the regulatory risk weights. But if I split between Italian government bonds and rest of the securities, I find the same results. Why is this interesting? Well, Italian government bonds, OECD is an OECD country, no? So regulatory risk weights are 0. Okay, so still, you know, you see, we find the results also there. So even within direct government bonds, the banks with low capital after a shock are going to lower yield, which typically means they're going to for lower maturity bonds. So no regulation. But what about the other two? So it could be that, you know, the supervisor comes in and say, well, you should do this and that. Okay, or it could be that the banks does it because, you know, wants to preserve the value and doesn't want to go bankrupt and become more cautious. So we do 3 tests to shed light on these. So these are based on different accounting portfolio, distribution of capital, franchise value. So accounting portfolios. So we know whether they are in held to maturity securities or in other portfolios. What is the key difference? If a security is in the held to maturity, basically whatever variation there is in the prices, if you don't sell, doesn't matter. Okay, so change in fair value doesn't matter. It's not reported anywhere, not in the balance sheet, not in the income statement. You put in the other portfolios, well, if you put in a trading portfolio, you need to recognize losses unrealized, right? So you're not selling, but unrealized just because of changing in the prices, you need to recognize in the income statement. Or in the available for sales, you need to recognize the balance sheet in the comprehensive income. So when we split these 2 types of portfolios, these are the results. So if the results were driven by supervision, we would have expected a similar behavior across the board. So in a sense, you know, if fragile banks are acting under the guidance of the supervisor, you know, banks would just reduce risk, you know, across portfolios. While we find that this is true only for the trading book and available for sale, and actually they even seems to try to get more risk in the held to maturity. Now, results are not significant at the conventional level, but it seems difficult to believe that the supervisor is dictating this type of differential behavior. Now, we look also at the distribution of capital. Why? Well, let's think of supervisor. So if you want to supervise banks and if these results that we find were driven by supervision, you would expect monotonic effects, strongly monotonic effects. Scrutiny, attention by the supervisor should be particularly important for the weaker the banks are. Okay, so we do 2 things. Okay, so we take the sample, we just put it in half. We drop all the cases where banks are fragile, in the sense that where the bank capital is below the median, we just throw them away. And we just take the subsample of relatively stronger banks, okay, where we think that the attention of the scrutiny of the supervisor and should be less relevant. And we find, as you can see, still very strong results. So also in this sample, relatively strong banks, still, if you have more capital, you go you can go for higher risk because maybe you have more risk-bearing capacity. The other thing is that this monotonicity, if instead of a continuous variable, we use quantiles for different quantiles of the distribution of capital, we should expect monotonic effect, going particularly strong in the bottom and then being much less important the more we go up for stronger banks. But as you can see, results are absolutely non-monotonic. Let me give the final evidence on these. So a more direct evidence, the banks do it because they care about it. So we find that more fragile banks take risk and respond to negative shock, less risk when they have enough franchise value. So when they care about the future profit, what is franchise value? It's discounted future profits coming from the fact that you have some rent position in the market. So we use these high franchise, low franchise. We use the Lerner index, which is a commonly used measure of market power. So you see, these results are only true in the subsample of banks which have high franchise value. Okay, so only when they care about the future, because they have some value coming from their market power, they do it. Particularly the low capitalized banks become more cautious because they care. So moreover, again, if results were to be driven by supervision, we would have expected, in a sense, a stronger effect in the low franchise, because not only they have low capital, but also in expectation, because of their position, they will have less. So, and we don't find this is the case. Now, what the concern with these is, okay, I'm showing to you that banks with more fragile, they take a little bit, they go for lower yield. Okay, but it could still be the case that they go for lower yield, but they concentrate anything on one issuer, for instance, or on one type of security. Concentration risk is another important risk for portfolios. Now, so we address this concern. We go at bank level. We use a dependent variable. So we use here all the securities. Share of security issue, for instance, just by data, maybe they are concentrating just on the Italian government or just by particular issue, or we use, a Findal index of concentration as it's been used in the past. We don't find any evidence that this is the case. So so I'm about to conclude with the last test is coming from the COVID-19. I show you the evidence of the Euribor spread for the previous crisis. Now there was a similar behavior of this index also during the COVID-19, starting in March and then picking up in April. Now, so we do basically the same thing, but looking at 6 months window before and after this shock. We find exactly, again, the same results. We will look starting in March, we consider COVID starting in February, find exactly the same result. Now, why is this interesting? One could say, well, external validity. No, but here it's more interesting because it's a different shock. It's not originated from the banking sector. On addition, it's different from previous shocks because there's been a softening of banking regulation and supervision. Still, we find the same results. So we conclude by saying that we analyze whether this idea that banks gamble when they're close to distress, we become more cautious. And thanks to this comprehensive data set, stronger identification, more complete analysis, leads us to a conclusion which is very different from the previous literature. So I think this is interesting I think also in general, because the literature on risk shift, the empirical evidence on risk shifting in industrial sector is not that clear. So there are some papers which go in favor, some papers which against. So here we are in favor, we do this study in an institution characterized by very high leverage, opportunity to quickly change their risk exposure. And also in this specific circumstance, we still find that risk mitigating dominate risk shifting when companies get close to distress, which suggests that economic forces are really important, in particular the idea of franchise value to drive the results. Thank you very much.
Great. Thank you very much, Andrea, also for staying on time. I actually use the Landier, Scher and Tesma paper to convince students that there is risk shifting is a real thing. But as you say, it's about a real estate investment trust, not a bank. And it's also one institution. So to convince people that bank governance has this fundamental problem is challenging if you can't show them results from banks. And I think you've really filled that gap. So it's a great paper, and I certainly personally look forward to using it in that particular context.